Option trading volumes in India are falling hard. Everyone is blaming SEBI, new rules, margin hikes, expiry changes. But what if I told you this exact thing has happened before? Not once, but twice. First in South Korea, then in China. And now India is entering the same exact cycle. This isn't random. This is the derivatives clampdown cycle. It starts with the explosive growth, then regulators panic, then the market dies, and history shows it takes almost a decade before things normalize again. So, is SEBI killing option trading? So, let's go back in time. South Korea, 2008. Believe it or not, back then they were the largest derivative market in the world. Like right now, NSE is the biggest derivative market, right? Back then, South Korea was the biggest derivative market, bigger than US, bigger than Europe, and retailers loved weekly options, just like Bank Nifty last year. Volumes were insane, like literally insane level of volumes. Regulators got nervous, they saw retail losses, crazy leverages, and they thought we need to protect investors. Okay, so between 2008 to 2011, they increased margin requirements by 70%. They forced retail traders to do hours of mandatory training. They cut down on weekly expiries, just like Bank Nifty's and other index expiries were removed of weekly series. They added strict intraday limits, and guess what happened? By 2012, derivatives volume had fallen 70%. 2 years later, the volume was down 92%. Can you imagine? Volume of the entire derivatives market down 92%. Regulators thought cash equities would be fine, but hedging became more expensive. FIIs left because they could not hedge, liquidity vanished, and spreads widened. By 2013, South Korea was not even in the top 10 derivatives market anymore. Years later, they realized their mistake. They rolled back almost everything, reduced training hours, cut capital requirements, added weekly expiries back, but the damage has been done. The volume has never recovered to its peak. Like the volume is still, if okay, let me show you. If this was the South Korean volume, okay, and this is when they introduced the rules and expiry changes, it fell 92%. Even after rolling back every feature, it has never recovered its all-time high of volume ever again, because FIIs have seen that regulators can manipulate the market. So why should they even invest in South Korea? Why should they even hedge in South Korea when they have a lot more markets, and a market like the US where the Nasdaq has given 70% returns in 2 years? So that is the first case, and now let's move to the second case. Now let's jump to China, 2015. The stock market crashed, regulators needed something. And guess who they blamed? Short sellers and derivatives trader. Yes, short sellers, like the people who short the market. They blamed them, and the derivatives traders like me and you. They made hedging almost impossible. Sounds familiar? Again, volume collapsed, and they realized the damage a few years later and rolled back the rules. But like South Korea, the derivatives market never got up back to its former glory. So again, the same case. But in this case, instead of the volume reaching all-time high like India, in China, their stock markets crashed, and they blame the short sellers and the derivatives trader for causing that crash. Now, that is something that they did stupid, because if somebody makes hedging expensive, nobody will invest in equities anymore, because hedging makes you like more safer towards making investment in the market, because if the market does suddenly go down, you can short the futures and be hedged always. So yeah, now India today, 2023 to 2025, Bank Nifty volume, it has fallen 54% in from January 2025 to August 2025. Bank X has fallen 94%. Next 50 has fallen 63%, and Nifty 50 futures have fallen 39%. 39% volume reduction in just about 8 months. NSE became the largest derivative exchange in the world, by volume. Retail piled in, SEBI loved it until they didn't. Now, higher margin requirements, ban list, and expiry overload, just like Korea and China, volume are already rolling over. We are at the start of the cycle, and here's how the next 5 years can play out if SEBI keeps, you know, doing this. So the phase one, we have already crossed that. Phase one was the boom. Like volume hit all time high, and all time high. Then they removed weekly expiries and made derivatives more challenging to trade. The volume started falling and falling, and now we have already fallen about 50% across the market average. But I think they will realize this at about 2028 that they have messed up really bad. So they will, roll back the changes. I have mentioned this multiple times to, people I know on Telegram. But the market will never fully recover because the damage has been done. People don't come back. People have already started moving to crypto. Crypto has seen almost 200 300% in FNO activity. The largest exchange, the Delta exchange in India, has seen more than 300% in the last 8 months. Sounds a bit coincidental, right? That the volume in India fell about 50%, and the same in the same time the volume in the crypto market increased about 300%. So that is a bit coincidental, but you can do what you want with that information. In Korea, this lasted 8 years. In China, about 5. For India, expect about 7 years because India is a very retail heavy driven market. No, unlike China, where they still had, institutions. So, what does this mean for you? If you are a retail gambler, this era is ending. Your leverage is gone. You can no longer go on a weekly expiry and hope for a 10x bet. Your cost will explode and the volume will keep falling. If you are a prop desk or a hedge fund, your hedging costs are about to go way more expensive. If you are a quant or a data trader like me, well, you will be most likely fine because you use strategies. I mean, I'm talking to real quants, okay, not the ones who just use indicators. I'm talking about the ones who use arbitrage, pair trading, and all of these strategies. You will most likely be fine, but you will need to adapt. And by adapt, I mean really adapt really hard because the slippage will increase and the margin has already increased. So yeah, you might survive. If the retail most likely won't, prop desk would most likely survive again. And SEBI, they'll keep saying it's for investor protection, but the history says regulators always overcorrect, and by the time they realize the damage, it's already too late. So is SEBI killing option trading? Not intentionally, but history shows us exactly where this is heading. We are in the same cycle as South Korea and China went through. Unless something changes, the golden age of Indian derivatives are already over. So, what's the smart move? Stop thinking about that this is a short term volume dip. It's not. The volume once leaves is hard to come by again. Understand that this is an 8-year cycle. Most traders won't survive it. But if you're building tools, if you are being systematic, you are coding your strategies, you are backtesting them, you understand slippage, bid ask spreads, and actual quant strategies, this is your time to adapt. You will win because once the volume leaves, more inefficiencies come in the markets. And if I just want to show you to prove this that India is already in the phase of the clamp down. See, this is the chart on the 1 day time frame. What do you see? Complete sideways market, right? This is not random. The volume started dipping at about April, okay? From April, the volume started falling hard after the tariffs saga that happened over here. After this point, the volume started drying, the volumes fell exponentially. And from then, guess what? For the past 90 days, 95 actually, we have been inside this 3% range, 3% on the upside and 3% on the downside. We have been in this one range for the past 90 days. And if I go to about a bigger range from, like, let's say this range, we have been inside this one range. And I'm telling you, like, it can happen like 2022. In 2022, this happened. But at that time, it was due to, like, from the rate hike cycle, but it can happen again. The market can go up down for like a lot of time. This lasted about 180 days, okay? And we are only at 90 right now. So this is why I said don't just follow the herd. Study history because the Indian market isn't unique, okay? It is very retail driven and it's just the next chapter of global derivative cycle.